Assalamualaikum and hello everyone. Welcome back. This is the second video dealing with the presentation and preparation of Consolidated Statement of Financial Position, and we are using question September 2014 that has been edited to suit the current requirement of the MFRS that are being used, and also relevant to the IFRS use, which is IFRS 10 and FAR 3, and we are dealing with the consolidation adjustment for the additional information provided. We are now in additional information number 3. So if you look at additional information number 3, you would notice that the closing inventories of Rainbow, earlier we have identified that Rainbow is the parent company. So the parent company is Rainbow. So I just go and get my pen first. So Rainbow is the parent company. So this closing inventory of Rainbow included 150,000 in respect of goods purchased from Shini. So Rainbow is the parent company, and it is buying goods from the subsidiary. Subsidiary here is Shini. So Shini is the subsidiary company, and Shini is also the seller. Shini sold these goods at cost plus 20%. Cost plus 20%, this refers to 20 over 120, which is the markup. At the year end, 40% of this good, which is the goods that were purchased by Rainbow from Shini, it was unsold, and that was also unpaid. So there will be two adjustments that are needed here, and that is going to be related to this figure. The first one is to eliminate the unpaid amount, which is the amount owing between the parent and the subsidiaries, where to the buyer and to the seller. So to the seller, there is an account receivable that relate to the group member, and the group member here is the parent. To the buyer, there is an accounts payable that relates to also group member, and the group member here is the subsidiary. So this is going to be also being eliminated. By how much? It is going to be adjusted by 150,000 times 40%. So if you can see here that I have prepared for you, okay, the elimination of unrealized profit needs to be done together with that elimination for the intercompany accounts payable and receivable balance. Before that, our unrealized profit, unsold inventories, yes, it is 60,000. If you take this 150,000 multiplied by 40%, you have 60,000. Remember, seller is the subsidiary company, buyer is the parent. So unrealized profit will be adjusted in the seller. It will be adjusted in the seller. So seller's retained profit will have to remove the unrealized profit. So the elimination of unrealized profit, you need to first calculate how much. 20 over 120%, which is the markup, multiplied with the unsold inventory. So this is the unsold inventory, 60,000. The unsold inventory. So this unsold inventory of 60,000 will have to be adjusted, right? This is the same 60,000, and multiplied by the markup given. So you have 10,000. So that 10,000 is the unrealized profit that needs to be removed. So you will debit the retained profit of the seller. The seller here is the subsidiary, so it should be the retained profit of the subsidiary company, the seller, right? 10,000, and that will have to be adjusted in your schedule. So your schedule will adjust that as well. So that will be adjusted in the schedule. And the second one is that it will be credited directly to the inventories. Remember, we are removing this because we cannot realize the profits that are related to the group member, where the profits that can be recognized should be the one from outsider, the one that were earned from the outsider. So here you have 10,000. So when you credit inventories, you need to go later to adjust the current asset in your consolidated statement of financial position. But bear in mind, this one must be adjusted in the retained profit, which is in the schedule that you will prepare, or the workings that you prepare. You can also do that in your worksheet. But for today, our focus is using the schedule, not the worksheet. Next is to be eliminating the amount owing, elimination of the amount owing between group members, amount owing. So amount owing, or this is related to due to the intercompany balance of accounts payable and accounts receivable. So these are the two things that will be removed. So how much? Debit the accounts payable in the accounts payable Shini, 60,000, right? Credit accounts receivable Rainbow, 60,000, right? So for your information, the seller again is Shini, and therefore under Shini, right, the accounts receivable must be accounts payable must be debited, right? And under the subsidiary is the adjustment here, and this is the one under the parent company, right? So it has to be adjusted, but this is actually a memorandum account. So you will remove the accounts receivable that relates to the buyer. The buyer here is the subsidiary. You will also remove the accounts payable that relates to the case here. The buyer, the seller is Shini, so therefore it will also be removed, right? Here 60,000 and 60,000. So that will later be adjusted. Even if you do not write Shini, or you do not write the word rainbow here, you are still correct, right? Because what we are doing is we are just trying to remove the accounts payable. Next one is information number 4, accounts payable and account receivable. Information number 4 is on income from subsidiary, and particularly this is on dividend from subsidiary company. So if you look for number 4, Rainbow had credited its ordinary dividend receivable from Shini. So the question clearly inform you, but you can also know where is it by referring to the information given that this has actually happened. So if you look at your ordinary dividend payable by Shini, a different color will make things easier, I guess. Okay, you have 300,000 ordinary dividend receivable payable by Shini. So the parent has taken credit or has already recognized that. So you need to check whether this 225,000 has it included the share of the parent. So to do that, what you can do is you need to actually eliminate this intra-group dividend. So subsidiary company has recorded its ordinary dividend. This 300,000 appear here, as I have shown you just now, appear here. And that is under current liability of Shini. Parent also has recorded its share of income, so it appears as part of the current asset. So 225,000 here, you can actually calculate and confirm that this is 300,000, the dividend by the subsidiary, times 75%. 75%, because that is the ordinary dividend receivable by the parent. So meaning to say that whatever you have here is all income from subsidiary, and this must not be reported anymore in the consolidated statement of financial position. They are intercompany transactions, so that must be eliminated. So when you eliminate, this is situation number 1, where both holding and subsidiary company have recorded the dividend. So you are going to go and remove from this 300,000, how much? 225,000, and that will be offset against the ordinary dividend receivable, since these two are intercompany transaction relating to 225,000. This will not be affecting your schedule because you have already recorded the share of dividend. What would be affected is the current liability section and the current asset section. So current asset will no longer report the ordinary dividend receivable, but current liability will just report the one paid to the non-controlling interest. You are not going to report 300,000. It's going to, what to be reported by the subsidiary would be 300,000 minus the intra-group transaction, and this is the intra-group transaction because we have already calculated that 300,000 times 75% is 225, so that must be eliminated. The next one is information number 5. Number 5, half of the bills payable of Shini. So go to bills payable of Shini. Bills payable of Shini. Right. Bills payable of Shini here, 130. Out of this 130, half of it, half from 130 were in favor of Rainbow. So it means that that is another intercompany bills. And you are not informed which or how much was being discounted or what was undiscounted. So if that is the situation, since no information is stating about what being discounted or not discounted, we shall assume that these are all undiscounted unless stated otherwise. So what we need to do is we need to go and make assumption that these are all undiscounted, and you need to go and eliminate that undiscounted bill. How much is the undiscounted bill? It is not 130, not 130 here, but only half of it, because the question clearly mentioned it is half. And 65,000, assuming those are undiscounted bills. So under bills payable of Shini, you will go and remove 65,000. That will be also adjusted under your current liabilities later. So you need to remove from the total bill this intra-group transaction under the current liability. The same thing must be done under the current asset, where the total bill will also exclude this undiscounted bill of 65. So that will be done later. Now we go to number 6, which is relating to intra-group sale of depreciable asset, where on 1st February year 4, Rainbow is the parent company. So Rainbow is the seller. Okay, so Rainbow is the seller. So I'm going to put here seller. Sorry about that. So this is the seller. I put here seller. Okay then. So Rainbow is the seller. And Rainbow is the parent company. So parent company, meaning that the buyer is the subsidiary. So buyer is subsidiary. Shini is the subsidiary. So Shini is the buyer. and it is the subsidiary. So the plan was bought by Rainbow on 15th of March, year 2. So the transaction took place right somewhere after the, if you look at the date of acquisition, 1st of July, year 2. So this that was bought on 15th of March, year 2. That was the date of purchase actually. Date of purchase. However, we are not interested so much in that. We are interested on the date of disposal. So our year end is again 30th of June, year 4, and this is 1st of February. 1st of February, year 4. So it was disposed in the current year. So this is 1st of July, year 3. So therefore this must not be reported in the company. We are talking about the group consolidation. Since the goods were sold, this is a plan, and this is a non-current asset that was sold at a profit. It was bought at 350,000 and now it is sold at a profit. Your duty is to find out what is the carrying value of this particular cost when on 1st of February 2000 X4. Alright, you need to find that, and you need to go and do some adjustment for depreciation. Okay, so what you need to do, we can already identify who is the seller, who is the buyer. So let's look at what we have here. Selling price is 230,000. So the transaction, or to find the carrying value, since it was purchased here, this is 1st of July, year 2. The date of purchase is 15th of March, year 2. So basically, you need to go and find out the carrying value in the current year. So you need to find out what are the carrying value after 2 years of acquisition, because the intercompany sale of asset took place in the current year. Therefore, if you do that, by 30th of June, year 2, here, you are to find the carrying value. You take 80%. Why 80%? Since the depreciation was 20%, so you are using depreciation on reducing balance method, right? So therefore, you need to go and gross up again. Yeah, you need to go and reduce the costs and find out what are the carrying value. So take the cost. So by 1 year, it will reduce by 20%. So 80% times 350,000. And this is the carrying value. Or you can also take 20% from 350,000 and then take 350,000 minus that amount that you calculated. But this is easier. You just reduce it by 20%. The following year, which is on 30th of June, year 3, 30th of June, year 3. This is the first year. So this one should be 30th of June, year 3. It would be 80% times the 280,000. 280,000 refers to the carrying value. So you take 80% because you are trying to reduce it further by 20%. So 224. So this 224 is your carrying value on the date of disposal, right? On the date of disposal, and that will give you 224. The unrealized profit is 6,000. So why do we go and adjust in the retained profit of the parent is because parent company is the one that sold the asset to the subsidiary. So you will debit retained profit Rainbow, the seller, 6,000. The difference between selling price and the carrying value, or you sometimes call it disposal proceed or disposal value. And that will be affecting the schedule under the retained profit column of the parent. That will be done later. And credit plan shiny, here is the buyer. That will be adjusted in the PPE section when you prepare your your consolidated statement of financial position. That will be done later. Right? We will just do the working first. Right? The second thing that need to be done is when you have your unrealized profit, you also need to go and adjust the seller's retained profit with the depreciation that were over provided by the buyer. So here I'm using the shortcut calculation for the calculation of depreciation that is being over provided. I'm not using the comparison method where looking at what provided by buyer versus what provided by seller. So you can also do this provided this is depreciation method reducing balance method. So this is reducing balance method. So I'll take the 6,000 straight away and I'll multiply by 20%. And then that will give you straight away the depreciation that has been over provided. If you try using the normal way, that is also going to give you the same answer. So you will go and reduce the retained profit with the depreciation. How do you reduce? You go and credit the retained profit of the seller with the depreciation of the buyer that has been over provided. Remember, we are looking at the group point of view. So 1,002. So that should be adjusted because debit to the plan, since there are no accumulated depreciation. The plan account of Shini is just at the carrying value. So go and add that because debit means to go and add, right? Increase the plant and machinery. Credit retained profit, that will also increase the revenue or the income, the net profit later in the schedule. Now we go to number 7. Number 7 is on debenture interests that were being provided by both companies. Both company means by both parent and subsidiary. They have provided, but that has not been recorded. So if you check even in your in your statement of financial position, you would see that they have not yet provided. There are no ordinary, so they are just preference and ordinary dividend here, no debenture interest. So you are going to provide, right? And this is relating to situation number 2. Situation number 2 is that where both parent and subsidiary have not recorded the interest. So let us look at the income from subsidiary point of view. Debenture interest will be an income to the parent whenever the subsidiary has proposed the debenture interest if the parent acquired the debenture. In our case, yes, parent acquire the debenture, and we earlier have calculated the percentage was, if I'm not mistaken, it was 30%. Yes, it is 30%, right? So therefore, that will give the share of the parent in the interest declared by the subsidiary. So since subsidiary has not recorded yet the interest, what you need to do is record that for the subsidiary. So the consolidation adjustment is to record that debenture interest first. The second one is to record the parent share of the interest income from Shini, the subsidiary. So first, when you record the debenture interest income here, you debit retained profit of Shini, since Shini is the subsidiary company that is recording the interest. So how much? 8%. So that 8% is 8% of this 400,000. 8% refers to the debenture interest. And this is for 1 year. Yearly debenture interest, 32,000. So that will be adjusting, it will be adjusted in the schedule under retained profit column. And credit debenture interest payable, this will appear in the current liability section in the preparation of consolidated statement of financial position. You need to include a new item, a line or item which is debenture interest payable. First you put 32,000. Then you need to record the parent share of interest income, and that was 30% based on our acquisition percentage from 32,000, so 9,600. And remember, this is an intra-group transaction, income from subsidiary. You record this in the schedule to record for the parent company. However, when you consolidate, you are doing the consolidation for the parent, you are not going to report this 9,006. So that will not be reported, right? So we'll see that in a short while, that we only report the debenture interest payable to other debenture holder, right? First you credit, now you debit. So what you report will just be this difference between 32 and 9,006. The next one is, if you read the question, you would also notice that the parent itself, because it says both company, also provide for the debenture interest. Parent also issue debenture. Here, if you can see, parent issue debenture of 500,000 and 8%. So parent also provide that debenture interest, 8% from 500,000. But no one is having any share because this is the parent, not the subsidiary. So the impact is that in the retained profit of the parent under the schedule of the parent, right, which is retained profit column of the parent. Then the debenture interest payable by Rainbow will be reflected in the consolidated statement of financial position. Next, and don't forget to do that adjustment later. Next one is for us to look at our adjustment number 8, which is on bonus issue. In this particular adjustment, you are informed that the directors of Shini have declared a bonus issue of 1 for every 10. 1 for every 10. And that is from the ordinary shares available. So ordinary shares available is 1.5 million. So there was extra 0 here. I will remove. Okay. Okay, that's okay actually. I just noticed that. Okay, correct. 1.5 there. So the bonus issue would be 1/10, and you are informed here that bonus issue will utilize the general reserve. So as I have mentioned earlier, for the bonus issue can either be from post-acquisition or pre-acquisition. It can either be from pre-acquisition reserve, it can be from pre-acquisition general reserve, or maybe pre-acquisition retained profit. Here, no, it is from general reserve. It can also be from post-acquisition. So we are using general reserve. But we are going to decide whether pre or post by looking at the balances that is available. So if you look at the balances available, on the date of acquisition, you have 270,000. You have balance which is 270,000. And if you calculate the bonus issue, it would be just 150,000. Look at the credit side here. So it means that the balance available in the general reserve of subsidiary on the day of acquisition is more than enough to finance the bonus issue. And therefore, the bonus issue will be taken out of the pre-acquisition reserve of Shini. So it will be out of pre-acquisition. It is not out of post. Okay, if you are interested to know the treatment of bonus issue out of post-acquisition reserve, I have published a video using another question, September 2011 edited version, where I have shown the detail on bonus issue out of post-acquisition reserve. But here our focus is bonus issue on pre-acquisition reserve. As I said, you can use general reserve, you can use retained profit, and any other reserve, for example, asset revaluation reserve as well. So you will debit general reserve. Remember, we are utilizing the balance. So when this happens, it will affect the fair value of net asset because we are utilizing the balance on the day of acquisition. Same goes for the share capital. You cannot simply go and eliminate the share capital and calculate goodwill straight away if you have a bonus issue. If you have an adjustment related to bonus issue, you need to first do the adjustment relating to the bonus issue, since the share capital of the subsidiary after the bonus issue would have increased by 150,000, right? Why do we adjust to the general reserve on the date of acquisition? Because there is already enough balance to cover up the bonus issue of 150,000. Again, remember that is 270,000, which is more than enough. So you will do this. This is the only adjustment. And when you do this adjustment, it will affect the calculation of your goodwill, because fair value of an asset is one of the items that need to be considered when you are calculating goodwill. So that must be adjusted there. As well as when you prepare your schedule, you also need to go and show the impact of the bonus issue in your schedule under the reserve that is being utilized. And remember, this is the general reserve of the subsidiary. So you need to go and reduce that with the bonus issue of 150,000. The last item is on impairment of goodwill. So to do this impairment loss, you need to first calculate the goodwill. So we will not calculate the goodwill yet, because we will be doing it in the next video. After that, we will be doing the impairment loss. But you should try and do the calculation of the goodwill and see whether you can get an impairment loss, as I've put here, 81,000. I'll see you in the next video. Catch me there. I'll see you there. I'll see you when I will see you. Thank you for your attention. Thank you for watching. Assalamualaikum. I'm signing off.